Well, hello everyone. Welcome to Trading Price Patterns. My name is Barbara Armstrong. I'm a coach with Charles Schwab. Delighted to be back with you again. As many of you know, the last 6 weeks I have been gone with the Barb 2.0 project, as I like to call it. Others might call it a knee replacement. I think that just requires less imagination. But yeah, wish I'd done that years ago. Wasn't expecting to feel so tired. I delusionally thought of this as my knee replacement vacation. Yeah, it didn't quite work out that way between rehab, ice, elevation, and sleep. I was pretty busy, but it's good to be back. So thank you all for joining me today. Today, we're going to talk about pennant patterns, and we're going to look at both bullish and bearish breakouts from pennant patterns. So that is the price pattern we are going to focus on today. This is a technical analysis class in that it's a class where we discuss price patterns. But, you know, other approaches, being aware of what's going on with earnings, what's going on in the market. You know, there's a little bit of a meeting being talked about this afternoon. Powell may be involved, you know, and that can influence markets as well. Earnings season, all that good stuff. So the Paper Money platform on the Thinkorswim desktop, that is the platform that we are using, and it is a brilliant place to learn not only how to place a trade on the platform, but to make sure you're familiar with a trading strategy before you consider trading it in a live account. Know that with short options in Paper Money, they'll never be assigned early, but in a live account, that can happen. Have I seen it happen? Yes, I have. And so, you know, if it happens to you, especially if it's something like a short put vertical where all of a sudden you own a bunch of really expensive stock that you had no desire to own, it can kind of take your breath away. You know, so just be aware that that is a possibility. And we talk in some classes about how to manage that. I've got a couple of quick announcements. We're going to do a very limited overview. Kevin Horner does a class on Wednesday mornings with Brent Moores. If you missed it, go back and watch it because he spends an entire 45 minutes talking about you know, the market and an overview of the markets. And so I don't want to be redundant. We're going to play some new example trades. Today, we're going to be light on trade management because I've been gone for the last 6 weeks. So yeah, we'll pick the trade management piece of that up again next week. Okay. Okay. So for announcements, first of all, Kevin has been he has been traveling all over the place. He's been in Anaheim and Chicago and New York. And I've been a little bit jealous because I've been here at home, you know, thinking I'm doing well to do a spin around the block. But if you've never been to a live event, these are absolutely fantastic. There is one coming up before the Dallas Market Drive in September, and that is a 2-day event in DC that Kevin will be at along with Ben Watson and a cast of other people. You know, if you're interested in attending that, that's the weekend of the 10th. It'll be the 12th and 13th. And then we have the Dallas Market Drive on September 20th. I'll be at that one. And then we're just fleshing out Chicago and Orlando, but you can register for all of these now. The one in Anaheim this summer, we were like packed to the rafters and we had to close registration. So if you live in these areas or you're interested in going there, don't register quickly. Okay. The other thing I just briefly wanted to mention is, oops. Okay. I'm all over the place here. This was a different thing that I was doing. Let me just bring up Google. Dang it. I just seem to be having issues these days in, you know, my first 2 classes. Oh, for crying out loud. I had this all set up prior to the class beginning. Just give me 1 second here, and I will bring this back up. Thank you. Alrighty, guys, I am so sorry. I had a brief internet glitch and it threw me out of a bunch of stuff. So, but now we're back. And yeah, the point I wanted to make on X, I posted something with a little car saying "follow me," and I'm getting a lot of scammers who are posting in the chat. So I am posting things, and only if I follow you can you comment on them. So if you put in the comments below, like if you just reply, "Please follow me," I'll make sure that I follow you, and then I'll post something again tomorrow, with kind of the same message, because a lot of people do like to reply to these things, and I just want to weed out the scammers. So there's that. Okay, so let's go out and start looking at some charts. And it was interesting because as I started to look at things today, there were a few stocks that came up. One of them was Walmart. And when we look at, I said I would do a really brief overview. When we look at the S&P overall, I mean, the last couple of days, it looks like it's setting up a bit of a bull flag. So we've had a 4-day pullback, but it's just kissing the 30-day moving average now. And we have moved up pretty dramatically from that April 6th low. And so we aren't seeing any kind of break of support yet. And, we're seeing, a rally from that April low of over 30%. The NASDAQ is closer to 40. And again, it's sitting on that 30-day moving average. We've had a several-day pullback, but, Chicken Little may be warming up, but she's still in the barn. We're up here, 39%. Well, from where it is right now, 40%. At the peak, we were up almost 45%. So, no need to panic, no need to be wringing your hands or gnashing your teeth, at least not yet. And when I was looking at, what I was going to discuss today, some charts came up like Walmart, and I thought, and this is one of the charts I think I posted on X just as an example of a triple bottom pattern. Do you see that? Where we had this triple bottom and then it came back, it broke out and then came back and retested. So, when we look at this, here's our triple bottom, and then we had this breakout and then a retest, and it's just bouncing nicely. So this is kind of a classic, triple bottom pattern. But we have something happening tomorrow, and that is earnings. And so, with earnings, sometimes we can get really dramatic moves to the upside, and sometimes we can get really dramatic moves to the downside. And so if you're trying to trade conservatively in an environment that right now might feel, excuse me, a little more volatile than it has been. And if we want to look at volatility, we can look at the VIX. And, it's only up 4%. But when the market opened today, it really had a pretty dramatic spike. Excuse me. Just gonna have a little sip of my water. So, when we look at a stock like Walmart, we might say, well, given earnings is tomorrow, as much as this chart technically may look interesting and provide us with an opportunity for an example trade, with earnings coming tomorrow, we might decide to pass. Now, others might say, but Barb, this is the perfect time to do a short put vertical type trade because the premiums are going to be so rich. And this is true. Premiums are rich, and some traders will place a trade exactly for that reason if they're confident in what they're seeing in the chart. And others will say, it's not worth the risk of something gapping either. If it gaps to the upside, I mean, look at Target this morning. It didn't, did it? And yet that, we've had it just kind of nicely going up the hill and then kind of kaboom. And so now you go from, a really nice potential return to max loss overnight. And so we're going to take a pass on that. And that's why. Okay. Okay, so let's look at a different one. Let's look at Hershey. Now, Hershey, and we may have talked about this one yesterday in getting started with technical analysis, because Hershey was kind of setting up. You know, we had this series of higher lows, but that was coupled with lower highs. And so we were looking for a breakout. And today it's just, now we've got this diagonal resistance breakout. And some might say, well, this could be a breakout and it could be a fake out. And that is absolutely true. And that might color one, whether or not we want to do an example trade on this. It also might color the type of trade we want to do. Because if we want to give ourselves a little more latitude, we might say, well, I would rather do a stock trade then that gives me more time. And I also might want to have a look at what sector Hershey is in. And, you know, I'm just going to say right up front, I don't get to choose what, you know, sector a stock is put in. Some might say that chocolate and candy is a discretionary item. Obviously, the powers that created this index said that it's a staple. So Kit Kats, Twizzlers, Sour Strips, Whoppers, you know, Bubble Yum, Pirate's Booty. These are staples, my friends, in the eyes of the market. So, and why do I bring that up? Well, if we come over here and we look at the S&P 500 sector watch list, and this is just a public watch list, right? I just came down to sector indices. Well, in the last 4 weeks, which sectors have been strongest? Well, healthcare, communications, and staples. And so this is in that staples category. And, you know, given that we're seeing this type of price pattern with a breakout, you know, could we do perhaps a swing trade? And, you know, you can do a swing trade with a stock, you can do a swing trade with an option. You know, but the idea is to say, here was our previous high, 199. We could even make it 195. And so if we bought for 182, and if I bring up my little calculator and said, okay, if I put in a target of 195 and I subtract what I'm going to pay, 182, if we buy 100 shares of stock, 182.64, that's a potential return of $12 on that purchase of 182.64. So this is a short-term trade, and the potential return is 6.7 or 6.8%. So that's not too shabby if it works out. Now, what if it doesn't? Well, how do you define not working out? Well, you might say, well, if it comes back, if it ends up breaking to the downside. So if you wanted to be really conservative, you could say if it goes back below this diagonal breakout line around the 181 mark, you want out. Or you could come down here and say, hey, if it comes below this, like 178, and you're giving it a little more room, so you're taking more risk. But if you said, okay, this 178.63, if I go 2% below that, it's not going in the right direction. So if it gets to 175, it's not heading in the direction we want. Okay, so we're going to put a stop in at 175.05. And we're, you know, this particular account, you know, has about $500,000 in it. And so we could have a position size of up to, if 5% of the account would be 25,000. So we could buy 100 shares. So we're going to come to the trade tab, and we are going to right click, and we're going to buy custom with an OCO bracket. And we're going to put in our target. And what's our target? 195. I'll just close this so it makes everything a little easier to read. 195. And our exit is going to be at 175.05. 05. Now, when we put in a stop loss, is that a guarantee we're going to get out at exactly that price? No. If the stock were to gap down like Target did this morning and our stop was above where the stock opened, then we could easily be stopped out for a price that was lower than what we were expecting. Okay. So now on the other hand, it could gap above our price. You know, I'm not saying that's likely to happen, but it's a possibility. So these are not guarantees, but it will trigger a market order. And this is a limit order saying, hey, you don't sell this until it gets at or above 195. And then that triggers the order to sell. Okay. But we want to get at least that amount. And so we're going to put this in our stocks with targets. And yesterday we did two similar types of trades in our, as examples in our account. And so if we come to the monitor tab, one is doing well today and one is not. So we did one on McDonald's and we did one on Uber. And so if you want to see a similar type of pattern, so here's McDonald's. We put this in yesterday. If we wanted to put that on our chart, as I kind of like to do, here's where we got in and here's our target. And again, you know, this is a pennant pattern where we had a breakout to the upside. And then Uber was the other one. And we put that one in yesterday. And today it's pulling back. Now, we do have a stop on this, but it's come right back down and kissed our diagonal resistance line. And the expectation is that this old resistance level will now act as new support, and we'll just have to stay tuned and see if that in fact happens. So, you know, that's two similar types of patterns where we did example trades. And if you missed that, getting started with technical analysis, it's in the archives and you can go back and watch that also. Now, let's look at one that's broken out to the downside. And so let's look at UPS. So UPS was, you know, and it's been on the struggle bus this year. And why do I point that out? So like if we go to a year-to-date chart, you know, it's been kind of rolling down the hill all year long, right? It's down 30%. And why do I point this out? Because if we're going to do a bearish trade, it's kind of nice to follow the trend. And has the market been downtrending? Well, no, the markets have been uptrending since April. And, you know, this stock has been kind of trying to play along, but, you know, and we see this big triangle or pennant pattern setting up. And then we got to earnings and it got hammer smashed. And it went down and then it kept on going. And then it's kind of tried to rally. Exhausted, falling again. And so when we look at this and we see overall trend for the year down, a break to the downside out of a pennant pattern. And, you know, if you're going to measure a pennant pattern, say that 3 times fast, Polly Pocket. If we look at where this pattern, the width of this pattern, so if I come from here to here, that's a $29 move, $29.40. So if I come here, I'm going to have to add. So we're going to come to our price axis. And we don't need room to the upside. We need room to the downside. So we're going to make that 15%. And we're going to say, okay, from here, you know, that's at close to 100. If I went $29 down, was that 29? Let me just do that again. There we go. Our price target would be around 70. Okay. Now, what if we're trying to do this conservatively, could we do a short call vertical? Now, if you're not familiar with this strategy, a short call vertical is kind of a neutral to bearish strategy where what we're doing is we're selling a call around this $89 mark. And then what we're going to do to define our risk, because when you sell a call, you're agreeing to sell shares that you don't own. So you've got unlimited risk. What if news came out and UPS really took off? So we're going to buy a call to define our risk. And the expectation is that the stock will stay below $89. And right now, it's sitting around 87. So the next question would be, are we going to get enough premium for it to be worth it to take that risk, to do that trade? So we're going to come up to our trade tab. We've got UPS. We're going to come out to the 19th of September. We're going to come over on the call side to 90 or 89. Now we've got thousands of contracts at 90. At 89, we've got 226 on the books, 71 traded today. We've got a 4-cent bid-ask spread. So we want to have at least 20 times the number of contracts. I have an example trading plan in the trade management mini session section. We want this to trade more than 1 million shares a day. So, when we look at that, we've got check, 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 check. The next thing is, are we getting enough premium? So we're going to look at selling our vertical. We'd get 39 cents on a dollar wide spread. If we went to $2 wide, which is a pretty huge premium. So if I get 69 cents, how much am I risking? Well, I'm risking $1.31 because I'm risking $2 minus the premium. So if I say, okay, if I can make 68 cents while risking $1.32, like that's more than 50%. That's 51%. Our goal is, if we're in it for 30 days, to make 30%. So we could do a couple of things here. We could say, well, maybe we don't need to be so greedy. Maybe we could make this 90. And will we still get enough premium at 90? When we look at these highs, that was 89.31, 89.41. So how about we make it 90? So we're going to make this 90. And then we're going to make this 92. So that's 55. So that's around 30-some% divided by 145. That's 37%. So that still, beats a poke in the eye with a sharp stick, as I like to say. And, let's say in this $500,000 account, you're willing to risk $2,500. So if we're willing to risk $2,500 and we're risking $1.45 a contract, I did something wrong there. We're not doing 17 contracts. Well, yeah, we could do 17 contracts. Now you might say, you may not want to do that many contracts, but $2,500 on a $500,000 account is half of 1%, right? So, is that taking an extraordinary amount of risk? Now you might say, well, I'm just new to all of this, so I don't want to risk more than $1,000 on any one trade. Well, then you structure that accordingly. But if we look at it this way, we're risking 2,448. So we're risking under 2,500. The most we can make is $952. Now what we're going to do is we're going to put in an exit and say, hey, just in case we're out golfing or walking the dog or doing your rehab exercises, you might say, Hey, when I've got 80% of my max gain, when this is worth about 11 cents, just go into the system and take my risk off the table. I'd like to buy this back. Okay. And so we're going to buy that back. Confirm and send. So we're risking $2,448 for the opportunity to potentially make 952. And we're not going for all 952. We're saying, you know, if we could get like 800 and change, we'd be happy. And we're going to put that in our, I don't know if I have a short call vertical bucket here. Yeah, we do. There we go. Fire in the hole. Okay, so there's one more in that venue I wanted to show you. And so I thought we'd go over to the healthcare sector. So we go over to Lilly. Well, Lilly's been getting a little silly. You know, and this is another stock. It's, you know, it's been on the struggle bus all year. It is down, you know, 9.7% year to date. And we can see another one of these pennant patterns setting up where, you know, it was kind of trying to hang with all the other cool kids who after April 7th or April 8th started up trending. So we were seeing, you know, it had this big immediate move to the upside. And although we started seeing higher lows, we had that one higher high and then, yeah, it started kind of languishing. And then we got to this earnings, the last two earnings. I mean, it has like gone to a window and, you know, or gone to the top of the 5-meter board and done a swan dive. And, you know, same thing here. You know, we got to earnings, even though it beat the estimates on August 7th, it fell again, and it's tried to rally and looks like it's pulling back again. So could we come and look above this candle, which closed at 714? So could we look at 715? Could we get enough premium and do that idea of the short call vertical? So it's kind of sort of bearish, you know, and if it just kind of languishes and starts going sideways, we'd still have a profitable trade. Now, if it continues to fall, you know, perhaps we could have made more doing a long put vertical or, you know, just a long put. But so that's why I say this is kind of sort of bearish. It's bearish to neutral. So we're going to look again at this 715. Delta of 42. So it's saying, you know, you have a 38% chance of this expiring out of the money, but you have a 78% chance that it might come up and at least kiss it sometime between now and September 19th. So if it does that, let's not get our knickers in a twist because the probability is high that that might happen. Okay. So, and we've got a 40-cent bid-ask spread on a $17 option. So we're good with our bid-ask spread, and we're looking to sell a vertical at 715 and 720. We get a $2, well, we're all over the place at the minute, but let's say $1.70 divided by 330. That's almost a 50% return, isn't it? 51. So could we go up a little higher? Maybe and take a little less, being a little more conservative. So could we do 720 instead, where the probabilities, the higher we go, the more this is in our favor. And we've got 1,200 contracts here. So now we go from a 78% chance of it kissing it to 72, a 36% probability of it being at 720 or above. So, whoops, we want to sell. So we're getting the same amount. Okay, well, that's a no-brainer then. And again, if we're willing to risk $2,500 and we're risking about $325 a contract, that's about 9 contracts maybe divided by 325, 8. 7. So we're going to do 7 contracts. And then we're going to do the same thing we did last time, which is say, hey, when I've got, and you might want to make it 90%, you can make it whatever you want, but we're just going to come up anywhere on these 2 peak lines, right click, opposite order. And if we stick with 20% as our example exit, say, hey, if this gets to about 35 cents, buy it back. S'il vous plaît. And we're going to put that in our short call vertical. Where did they go? There we go. Our short call vertical bucket. So we're risking 2,261 for the opportunity to make 1,239. And we're saying, actually, you know, if we can make 80% of that number, we'd be pretty happy. And then there are transaction fees. Okay. So we have to take those into account also. Now, just let me, something happened with my system and I am not able to see questions, unfortunately, today. So I'm going to have to get that sorted out for the next class. It's like, it felt so easy being back until, you know, something happened and then I'm just kind of trying to figure out where to go next. So what have we done today? Well, we've looked at a bunch of pennant patterns. We've placed 3 example trades. We did one on Hershey, which was a bullish trade, where we bought the stock and we put a price target being the previous high. And then we did one on UPS. We also did one on Lilly. And Lilly, while they're now saying they don't want to give us quite as much of a credit, so we're going to go back in and adjust it and say, hey, you know what? If we can get 170, we'd be happy. So we're going to change that. Short call vertical. There we go. So we did 3 example trades. We looked at a number of pennant patterns. Now there's lots of pennant patterns out there, and we looked at several that we're setting up. And this is where patience is required, because if we look at something like Merck, so this is another stock in the healthcare space. So we've got this horizontal line that's been acting as support, you know, so we've got similar highs and we've got higher lows, but has it broken through yet? It has not. So what do? Well, we could put in an alert and say, hey, if this gets to 85.50, let us know. If it breaks out, you know, or if it breaks out to the downside, or we may just want, you know, want to keep an eye on it. But we could create an alert by coming in here and saying, hey, if this goes at or above 85.50, let me know. Bullish trade possibility. And we'll just have that in the system. How about XYZ? Oh, XYZ. And again, now here's one, you know, we recently had earnings and man, there was a lot of drama that day. But, you know, we've had a series of higher lows coupled with lower highs. And today it broke down below that, but we see that it opened, cruised lower, and it's now trying to rally. So, you know, could this be not a breakout, but a fake out? We may want to give it another day or so and just keep our eye on it. Okay. So speaking of on it, let's look at on. And on is one, you know, again, we're seeing kind of a resistance level here that has become a support level, and it's consolidating. But, we've got this diagonal resistance line here, and we're waiting for a breakout. But we did have a pennant pattern here where it did break out. And if you'd measured this target, it did end up going up and hitting that target. How about we look at Carvana? Maybe, maybe not. And this will be our last one. Again, here's another pennant pattern setting up. We had this break to the downside, but then it's rallied pretty dramatically. So, and what's the difference between this and the other two we looked at that broke to the downside? Well, the other two that we looked at, UPS, this is down 30% year to date, and it's been downtrending all year. When we look at Carvana, it's up 60% year to date. And it was continuing to uptrend, and then we had this break, and from where it opened, it's rallied pretty dramatically. It's just not back up over the line yet. So do you really want, this would still be in many traders' eyes, a counter trend trade, because it's not following the longer term trend and the intermediate term trend. And so we might say, I think I'm just going to pass on that. So I hope you have found this conversation about pennants and triangles today helpful. I hope you have found the 3 example trades that we placed today helpful. One was bullish, as I said, and 2 were bearish. And we'll follow up on these in weeks to come. I appreciate you joining me. Again, don't forget to follow us in the land of X. Let me just bring my PowerPoint back up. Don't forget to follow us in the land of X, Kevin Horner CS and Barb Armstrong CS. Don't forget to look at those in-person events and consider attending one. I loved going to them when I was a client, and I love attending them still as a coach. It's great to just be in community and let the distractions at home just be out of your way, and be in a community of other like-minded people who are wanting to learn and grow in their expertise and knowledge of the market. So have a really awesome rest of your day. I will see you tomorrow. I'm covering for James Boyd, and we'll be teaching Trading the Trend. Take care, everyone. Bye for now.